Good afternoon and welcome to this roundtable organized by FUNCAS on the subject of European economic prospects in the face of very significant geopolitical tensions in the world and significantly, of course, in Europe. It is fair to say that this situation has rarely been so complex. While the EU was just recovering from a very significant shock from the pandemic, a new shock emerged in the form of escalating energy prices as well as supply bottlenecks of all kinds. These adverse trends gathered momentum during last year and reached their climax since the invasion of Ukraine. The most spectacular impact of this new supply shock to the world economy and significantly, of course, to the European economy is a surge of inflation not since the last few decades. Consumer prices increased by nearly 8% in March in the whole of the European Union, with 7 countries, no less than 7 countries, even recording double-digit rates, and 4 more getting close to it. The result of these trends is a significant erosion of purchasing power of households, as well as a significant erosion of profit margins of enterprises, thereby weakening the economic recovery which was and still is underway and aggravating social inequalities. Not to mention the risks to the global outlook associated with this situation, which could emerge especially if the supply of Russian oil was stopped in Europe. And with significant impacts, of course, also in terms of food prices in developing and emerging economies, therefore leading to a possible second round of major negative effects. Another problem, perhaps this is the most significant issue which we are facing, is that the space for policy action, the space for policy responses appears to be narrow and certainly much more limited than was the case at the time of the pandemic, when we had very low inflation rates, in fact, almost zero inflation rate. Therefore, there was easy scope for monetary policy, and the situation regarding public debt was not as difficult as it is today. Indeed, today, in view of the risk of second-round inflation effects, the ECB is already withdrawing the bond buying programs and also paving the way for higher interest rates. And similarly, governments face the challenge of having to curb the impact of the shock, but at the same time maintaining fiscal sustainability. For the EU as a whole, we are talking about a public debt of 88% of GDP, significantly more than the 60% target, and certainly 10 percentage points more than was the case before the pandemic. Of course, there are also good news. We should remember that. The EU started the year on a relatively strong footing, and actually the short-term indicators, PMIs or IFO index in Germany, showed relatively encouraging results until at least the invasion of Ukraine. Also, countries like Spain are benefiting from a relatively good tourism process, which should bode well in terms of, at least in that sector, economic growth. And of course, next generation programs appear to be even more relevant than was the case before, because there is a need for an energy transition, and therefore the focus of the next generation program on the energy transition is really welcome. More fundamentally, Europe is becoming aware of the need for reinforcing its geopolitical role. Nonetheless, there are some significant questions. First, what should be the policy approach to contain inflation while at the same time not derailing the recovery? And Spain, for instance, now is trying to do this through the negotiation of reform of the electricity markets, but there are other initiatives in many countries. And what is the space exactly for doing this and at the same time maintaining, in other words, cutting inflation, but at the same time maintaining recovery prospects? Secondly, should Europe do more in this regard? It's interesting to note that much of the action is very much country-specific action. When you look at Germany, France, Italy, or Spain, for example, to take the bigger economies, we are talking about country-specific programs to trying to deal with the inflation issue, and of course the ECB, but in terms of European economic policy or European fiscal policy, what should be the role? Third, looking longer term, how can concretely the EU regain strategic sovereignty in the face of geopolitical tensions? I think this is an issue which will be with us for many years, but certainly it's one which is worth discussing already today. We are privileged today to address these and other questions to have gathered a high-level panel indeed. First of all, Klaus Regling, Managing Director of the European Stability Mechanism, and as well as Director of the European Financial Stability Facility, a major body which has to do with crisis resolutions issues. Mr. Regling also has a long experience in the European Commission. He was Director General for Economy, as far as I remember, and also has an experience at the German Ministry of Finance. Let me also welcome Gonzalo García, Secretario de Estado de Economía y Apoyo a la Empresa, also with an extensive international experience at the IMF and the World Bank, among others. And finally, Belén Carreño, Senior Correspondent at Reuters, will moderate this roundtable. Belén has a solid tracking record as a sharp analyst on European economic issues, and especially in the case of Spain. So let me thank her for moderating this panel. And with all this in mind, Belén, you have the floor.
Thank you so much, Mr. Torres. You already mentioned all the big questions here, so we will try our best trying to answer all of them. Many thanks to FUNCAS for inviting me to moderate this roundtable. It's really an honor to be here this evening. Well, welcome to Spain, Mr. Regling. Gracias por estar aquí, Secretario de Estado. As our guests tonight have very different profiles and very different roles. Mr. Regling represents a high European institution, and Mr. Garcia represents like a government. I will try to adjust a little the questions and topics throughout our talk to adapt it to each of their competences. So let's start with Mr. Regling. Mr. Regling, the drivers of inflation looks to be very much beyond the control of governments. We are talking about supply disruptions caused by a war, caused by a pandemic, shortages. So what policies can European institutions deploy to control inflation without damaging economic growth?
Good evening, and it's a pleasure to be here. I intended to give now a little statement, but we could also move immediately to question and answers. I mean, I'm in your hands, whatever is more productive.
Oh, it's okay. I mean, go ahead with the statement.
For 10 minutes or so?
I will say 5, because if not, we are going to be very short time in our like the moderation.
I was actually told 15, but that's fine. As I said, we can also have changed the format, and I can try to answer your question immediately then. I wanted to give a broader European perspective, but that's okay. So let's talk about inflation. And as you say, indeed, we are facing, as also Mr. Torres said, very complex, exceptional circumstances. We haven't seen a war in Europe since 1945, and that has significant economic and political consequences for all of us. And the most visible is indeed what's happening to energy and food prices, and therefore to inflation. But of course, it also means that growth is decelerating. Markets and my institution, we are very much in contact with financial markets because we issue bonds and invest capital. So I see the forecasts coming from the markets, and they are a bit more pessimistic than the forecasts we see from official institutions. Last week we had the IMF spring meeting in Washington, where the IMF published its most recent forecast, and they reduced growth for this year for the euro area as a whole by 1 percentage point, from about 4 to 3%. When I look at markets, they are more down to 2%. And that would imply, if that number is correct, and I'm only reporting what I see in markets, we don't make our own forecasts, that there would be no growth within this year. Because we had from last year, where growth was very high, coming out of the pandemic. So it was because there was a big fall in growth in 2020. There was a big upswing last year, but it means that's why we have a positive growth carryover from 21 to 22 of 2 percentage points. And that means even if there's no growth within the year 2020, quarter by quarter, there would still be an average growth rate for the year as a whole of 2%. But one shouldn't then overlook that this really means no growth within the year. So that's on the growth side. Energy and food prices are high. The average inflation rate is high. The latest monthly figure came out this morning compared. So that was March this year compared to March last year. It's above 7% for the euro area as a whole. And that by itself means it's a huge loss in purchasing power, as you also said. That means real consumption, which is a big component of growth, will fall. But what is really bad, and not many have written about that because we have not experienced this for such a long time, is that what economists call the terms of trade loss that we experience. That's really bad. Terms of trade is the ratio between export prices and import prices. Our inflation, to a large extent, comes from import prices because energy for most of our countries, with the exception of Netherlands and France, is imported. So import prices are growing much faster than export prices, and that means a terms of trade loss. And when that happens, it basically means that a part of our income is transferred to the outside world, in this case, to the energy exporters. And the terms of trade loss so far is around 2.5% of GDP. And the numbers I mentioned is always euro area. So 2.5% of our GDP is just gone. And there's no way to replace it. Unless one day maybe export prices come down and then the terms of trades we may have a gain. But at the moment it's a loss. And if one tries to compensate for that, you get into trouble. That's what happened during the first oil price shock in the 70s. And actually today's terms of trade loss is bigger than it was at that time. So that's a real economic problem, and in the end also a political problem, because governments cannot do anything about that. Of course, they can help temporarily to support the most vulnerable groups in society and help some vulnerable companies so that they don't go bankrupt. But they cannot help everybody. This is just, and that's why this terms of trade concept is so important, and economists have not thought about it for a long time, but because it did not happen for a long time. But we are back to a situation where this was very important before 50 years ago, the first oil price shock. Let me add one more thought that I had intended to say in my introductory statement, which moves a bit away from energy and inflation. And that's more the political consequences of the war with, of course, economic implications. What we see, I think, is the world is reordering itself. So we are probably entering a new world order. For some time, we already had the conflict between the US and China on the trade side, but also politically. Who is the biggest power in the world? And the Chinese certainly want to, again, reach that status which they had for centuries until about 1800. And they're on a good way, so they will probably succeed. And the US doesn't like that. Of course, we are much closer to the US in terms of democracy, human rights, and all of these things. So that conflict was already there and led to some deglobalization. With the war in Ukraine, I think this will accelerate. And what is also interesting that I see the emergence of a third bloc in between, with countries like India, Indonesia, Brazil, South Africa, and a number of other countries in Africa and South America, they don't want to be forced to choose between China and the US. They want to remain independent. And I think it's very important to remain in good contact with them and make sure they don't drift too far away from our democratic bloc. So that's one lesson, I think. And in that context, very, very positive that today, right now, the president of the European Commission, Ursula von der Leyen, is actually in India to strengthen the economic and political links with India. I think that's a very, very wise decision. The other consequence that we in Europe should draw, and that brings me to my daily work, is to strengthen European integration, to strengthen monetary union, make it less vulnerable, more resilient. We have come a long way since the euro crisis 12 years ago by creating new institutions, including my own institution, which did not exist before the euro crisis. We also have the common supervisor, so the biggest European banks are supervised by the ECB. We have a number of other new institutions. That's all good, also helps in the current crisis. But there's still unfinished business. And the agenda is very clear. And I think the war in Ukraine and this evolution of a possible new world order makes it even more urgent to continue our work on strengthening Europe and the euro area. Also makes the euro more important in the international monetary system. And for that, we have to complete the banking union. We have to create a capital markets union, and we probably also have to add another fiscal capacity in the euro area for asymmetric shocks. So that's the agenda. The ministers of finance in the Eurogroup, they are working on it. It's not easy, there are different views, but my hope is that with this new world order and the ongoing conflict between China and the US, I think it's very important that we make progress on this agenda, because otherwise Europe is becoming too small. We need to speak with one voice. In 1950, when I was born, that's why I remember, the share of Europe in the global economy was, if I remember correctly, 24%. Today it's 13%, and in 2050, not that far away, 28 years, it will be 7%. If we don't integrate more and convey united messages to the rest of the world, we will be squeezed between these two superpowers, which will continue to grow faster than we, because our population is shrinking more than their population. And I think that's a good reason to act. The war in Ukraine, terrible, horrifying, but it may have this positive side effect of accelerating our move towards more integration. Let me end here. That wasn't too long. Hmm?
No, it was not long at all. I thank you so much for summarizing the statement. So sorry to adjust in the last minute this thing. This is what happens in live events sometimes, like the difficulties. But in any case, I would like to address the question again about how the EU institutions like the ESM can do to try to fight against the shock, the energy shock. How can they help? Well, because the role of the ESM in the previous crisis was very clear. So what can be the role of the ESM or another EU institutions in this moment?
Yeah. No, the ESM has no clear mandate to work on energy issues. Also, this is a topic for all EU member states. The ESM can only help countries that are members of the euro area, 19 countries that use the euro. They have created the ESM and gave us a lot of capital, so we can work with that and help them when they have a problem, like we had in the euro crisis. We may be able to help with other new facilities, but at the moment there's nothing on energy. That is also a problem that affects all EU member states, and therefore it's quite appropriate that the Commission, the European Commission, in the first instance is on the line to help. And to some extent, or to a large extent actually, The big pot of money that was created 2 years ago in the context of the pandemic, Next Generation EU with the Recovery and Resilience Facility, 800 billion euro, most of that money has not been dispersed. It was always the idea to disperse it over a 5-year period. So we are only about 1/3 through that, 2/3 is still coming. And that's also very helpful in the current context, because some of that money can still be redirected to be used for the new problems. The main purpose was always to support the move towards a greener economy. And greener economy has a lot to do with becoming more independent from fossil fuel and therefore from oil and gas, which is creating much of the current problem. So that's good, and more money could be spent on that, because some of the money is not allocated yet from this pot of money of 800 billion. So that is all very good, and that can be helpful. The Commission also tries to make sure that countries move together in a way. And unfortunately, what we are seeing so far is that a country X does one thing, reduces the VAT on gasoline, another country reduces other taxes, and it's not well coordinated, and that is not very efficient. So that is one thing where at the European level, more coordination, and the Commission tries to do that. More coordination would be useful, so that because then it becomes more efficient. Because if one country reduces by lowering taxes the price of a liter of gasoline, and the neighboring country doesn't do it, then there will be a lot of traffic into that country to get cheaper gasoline, not very efficient. Also, lowering taxes where everybody benefits from is very costly financially. So the Commission, and I would fully support that, is in favor of more targeted support for the low-income groups. It's cheaper, and we may run out of fiscal space eventually, and much more efficient as a subsidy. So there are a number of things that are being considered right now, but not from the ESM directly.
Okay, I would like to go back again after about the next generation funds and the role of the ESM, but now that you just mentioned this thing about, well, a reduction in taxes for everyone is not very efficient and it's very costly, I think is the term to the Secretario de Estado to give us their opinion, the view of the Madrid, because, well, precisely this Thursday, these kind of initiatives that you were mentioning are about to be approved definitively. So, well, we were looking forward very much today to know the new forecast for Spain. They have been delayed a little, so I'm afraid that Mr. Garcia is not going to give us some kind of really good news about good news or news in general about the new forecast for the GDP, but maybe you can explain to us how are the forecasts for inflation for Spain and in general for the EU, but overall for Spain, how long time can Spain support this kind of level of inflation without having spillover effects or second round effects? Obviously, if you want to mention something about what the lack of coordination that Mr. Gling just mentioned, well, you're invited. I hope you don't have a statement also, because I was not ready at all.
No,
okay, that's
no
great.
problem. I'm fine.
Okay.
I'm fine, and thank you so much for the invitation. A great pleasure to be here at FUNCAS and to share this dialogue with Klaus. Well, first of all, we're going to talk about economics this evening, but I think the most dire consequences of the invasion of Ukraine are humanitarian, are the losses of life and the displacements, and you need to bear in mind that we're dealing here with a humanitarian and security major problem that we haven't seen in Europe for decades. And of course, it has a very strong economic fallout, and as Klaus has outlined, this is really a major shock again, and we're getting used to really major shocks hitting our economies. This is a supply shock with an intensity that is not that far from the one in the 70s. It's not just a supply shock that started with the invasion. This started almost a year ago in the spring of 2021. It had to do with already the preparations that Russia was making for the invasion. And it has a great intensity, basically with respect to gas prices, which have really grown fivefold throughout this year, and of course this translates into a very sharp rise in the price of electricity, which is basic input for economic activities and for everyday lives of our citizens. I think the kind of recipes for supply shocks that I think and Klaus has referred to them, and I of course share many of his points, but there are, I think, some specific elements in the situation we're facing that need to be, I think, highlighted, because they affect a lot the policy response, and I'm going to try to explain how they have shaped our policy response. I think that this shock, of course, has a very different nature to the one we suffered with the pandemic. It is also exogenous. It has a clear and unambiguous European dimension. It affects Europe as a whole. It's global, but it affects Europe much more than it affects other countries. And it also shares with COVID that we have a supply side shock, but it comes with a layer of uncertainty, which is, I think, very, very high in the short term. We don't know what is going to happen in the summer and for the following months. And of course, that has an impact on our economies. I think in the face of this shock, and this comes at a situation where the European and the Spanish economies, we are kind of nicely recovering from the major shock of the pandemic. We have been recovering much faster than used to be the case. In the case of Spain, it's really stark contrast, the recovery with respect to previous crises. But this is not by coincidence. This is because I think the quality and the policy response that we've given at European level and also at domestic level in Europe has been, I think, much smarter than the one we did before. And that kind of puts us in a situation which is, again, we're facing this major headwind, but I think we're moving and we are on the right track, and we have the means to kind of overcome the situation. From our perspective in the Spanish government, the kind of economic policy response that we see to the shock, we need to kind of give a very forceful short-term response, because the consequences in the short term, as Raymond has explained at the outset, are very significant. This is an emergency in a way. We can see it in the electricity prices. We've been taking measures since June 2021, because we've been experiencing that from that period. And we also have to add that there are another kind of set of supply restrictions that were already hitting our economies, that the bottlenecks that we see for chips, that is weighing on the industries such as the automotive industry. So this whole situation is challenging. We need to respond in the short term, but that response needs to be kind of embedded and be consistent with the medium and long-term vision and response. Fortunately, we are in the middle of the deployment of the recovery plans, which are, I think, the medium to long-term response that is adequate for a situation like the one we're facing. Because the plans have a counter-cyclical element because that investment will help us to prop up growth throughout this period, and at the same time they kind of lay the ground for the kind of structural transformation that we need to face the consequences in terms of higher energy prices, in terms of high dependency of gas of some countries with respect to the Russian supply. So, and we also have this very ambitious program of structural reforms that is focused in the supply side. So when we have a supply side problem, what we need to do is to invest, is to kind of reinforce the capital base of the economy, the human capital, the technological capital, and that's what we're doing. And so we need to do both things, and that's what we've tried to do with our response plan to the consequences of the war, in which we try to address the short-term kind of challenges that we've seen in March. That we're seeing high inflation, we've seen the impact of higher costs for companies, and this creates a lot of short-term kind of disruptions in the economy, and we need to give a very strong response to that. We need to kind of make uncertainty kind of dissipate in the short term, to kind of have inflation. You said at the outset, well, countries cannot do things. Yes, we can do things, because in our response, there is an element that I think it's important. Klaus talked about the shock to the terms of trade. And of course, that happens for gas, but that is not the case for electricity. In Spain, last year, 45% of electricity was produced with renewables. Just 10 to 15% of the generation of electricity uses gas. So the fact that we are, because of how the electricity market works, and this is, of course, a European regulation, we are kind of extending the shock in the gas prices to the 85% of the generation that has not seen costs rise. I think it's a total economic nonsense, and that's what we've tried to we've really tried to address with the measures that we've adopted and we've been adopting.
But Mr. Garcia.
Yes, I'm coming back. I'm coming back to your question, but I think Klaus has made an open statement, an opening explanation. Please let me just finish, and I will go back to your questions in a second. I think it's very important that in that response we not just support, of course, those vulnerables with direct aid for companies and for households, but we also take the measures needed to kind of strengthen our position. And that's why we've been defending the need to kind of sever the link between gas prices and electricity prices in the short term as an exceptional element. And we haven't done that as a domestic policy. We've been trying to argue for a kind of a European response on that, and on that sense. It's very difficult because, of course, there are many people that think that the current system works well. The agreement that has been announced today, after the agreement that we had in the European Council to have this exceptional system that will apply to the Iberian Peninsula, I think it's very important. It's very important to protect us against kind of additional kind of macro impact coming from a situation which, of course, that we cannot control. And so, and I agree with the final remarks that Klaus was making on the European response. We are our policy, is always kind of consistent and trained in the European response. We think that we've made a huge progress with Next Generation, and we have to kind of do the same, follow the same path, because it has worked well with the situation that we're facing now.
Thank you. But I will insist a little.
No, go ahead.
First, Spain. You mentioned that Spain was taking short-term initiatives to try to solve some disruptions in the economy.
Yes.
I was wondering if it's not possible that these short-term initiatives cannot make another different disruptions in the economy. We heard some voices saying that lower taxes, we have just heard in this roundtable, lowering taxes to everyone or the rebates on fuel can be counterproductive. Even I will say, well, there are some voices saying they could be pro-inflationary. Because they are even encouraging people to spend more on precisely the elements, the factors that we are in the middle of a shortage or some kind of supply problems. So, well, I would like to know, how do you face this kind of criticism about the kind of package that Spain approved so far?
Yeah, well, you've talked about several things. In terms of taxes, I think the response is targeted to the problem. So, we've lowered the taxes on electricity already, almost.
Is the VAT, and they say specifically that this is not a good idea to lower VAT.
No,
right?
No. The European Commission, and the Parliament and the European Commission, it made a proposal with a revision of the VAT directive, and they are encouraging measures to kind of cushion the impact on energy prices in the short term. And this is based on the limits, on the leeway that the directives allow to countries. So I think almost every country is doing that. I think it has a lot of sense, because this is a major kind of distortion that is transitory, and we need to adopt measures to allow the economy to digest the shock in the short term. Inflation is already, the shock in costs and inflation is quite significant. We don't know how much will it last. There's a part that we will not control, but we need to make sure that the economy is able to adapt and to cushion that impact. And I think it is very important to adopt measures that, particularly for some sectors, in terms of the aid to sectors, we've taken very targeted measures for road transport, for agriculture, and for electricity intensive sectors. These are having, a huge impact already. We've had, as you know, 2 weeks where, the road transport have been completely disrupted. And of course, we're seeing industries that are kind of stopping production because of cost. So there is a need to have to take some targeted measures in the short terms. You probably have read today that the electricity demand is already diminishing.
Yes.
When you have a fivefold increase in the price of gas, and you have it's not a fivefold because of all of the measures that we've taken already to kind of cushion the impact on for companies and for households, but people are already kind of reducing their demand. But we really need these targeted measures in the short term to help the economy kind of weather this storm in the short term, and at the same time using and addressing the structural measures that will help us kind of overcome the situation. And we're doing that with renewables, with investments in renewables and storage, of course with energy efficiency. There's a need, and we have investments to significantly reduce demand, and also with measures on demand to transform mobility at all the sectors that use energy. So again, there is a need to kind of combine the short term with the structural, and I think that's what we're doing with the response.
Okay, thank you so much. Time will judge every decision make in this moment, as time has come and has passed by, and we are now seeing with the rear mirror sometimes, like what happened in 2008 and the role that the EU institutions had in that moment. I was wondering what is the role of the ESM right now, working out with the next generation funds at the same time. I don't know if they are complementing each other, or if they are they have any kind of relation. You mentioned twice, I will say in your first introduction, that maybe the ESM could host, I don't remember the exact word you said, like to try to boost any kind of new facility from the European Union. I don't know if you can explain it a little bit more. Thank you.
Yeah. So As I mentioned already, the ESM only works with its 19 member states, while the European Commission has to work with 27 member states. So that's one important distinction. And the European Commission, of course, has an all-encompassing mandate and is very active in many areas. The ESM has a very limited mandate, and it was created during the Euro crisis in order to help Euro area member states that lose market access or are close to losing market access. Spain, for instance, drew from the ESM 41 billion euros in 2012 and 13 to support the restructuring of the Spanish banking sector. And when we provide financial support, we provide loans, we issue bonds in the market at very low interest rates because we have a AAA rating, and then can give cheap loans to a country that needs it. We supported 5 countries during the Euro crisis. Greece received more money than anybody else, 200 billion euros between 2011 and 18. And the result was that we could keep Greece in the Euro area. If the ESM had not been created, I'm pretty sure Greece would no longer be in the Euro area. And that could have had some ripple effects also to other countries. We also helped Portugal, Ireland, and Cyprus with economic adjustment programs. But those were different days. Those were times when a number of countries like Greece, but also Ireland and Portugal, needed real macroeconomic adjustment. They had lost competitiveness. They had huge trade deficits, very large fiscal deficits. Spain and Ireland had housing bubbles, and when they burst, that became a big burden for the public sector, for the budget. So countries had to work to overcome the crisis. And that's why we had special facilities, special tools to support countries in that process. And we provided a lot of money in that context. Now the crisis, the last 2 crises, the pandemic first, and now the consequences of the war in Ukraine are very different types of crisis. This is not a question of a specific country like Greece that needs to adjust macroeconomic imbalances. These were symmetric shocks with some asymmetric consequences, but symmetric shocks where nobody can say there were policy mistakes that led to a loss in competitiveness that had to be corrected, nothing of that sort. And that's why the package that was agreed 2 years ago, the Next Generation EU package, that supports reforms and supports the transformation of economies towards green and digital, are exactly the right response. A very different response from our earlier programs to the Euro crisis. But the reason is that the origin of the crisis and the consequence of these crises is just very, very different. 12 years ago, countries had to do their homework. Now, it's a question of stimulating reform, promoting public investment, transforming the economies, and that's a similar agenda for all countries. So, and it's good that the European Commission does it because it affects all EU member states. If we did it, we could only help our 19 member states, and then what do the other 8 do? So, so that's a kind of division of labor. When there's a problem in the euro area, the ESM can step in and help, also by creating new facilities. If it's a common problem for the entire EU, like with the pandemic and now with the war, then it's good to have a common approach via the European Commission. But we work very closely with them together because we all analyze economic situations. We have to analyze that sustainability issues. We do all that together. The Commission also, when they were asked to implement the Next Generation EU, this was a huge program. They had never issued so many bonds. And because we had gained that experience 10 years earlier, we provide a lot of help from our own funding team. We lent them some of the ESM staff to help doing it. So because we all want to work for the same objective, to make Europe stronger. So there's a lot of interlinkages, a lot of cooperation, but distinct mandates and different operations.
what should be the role of the ESM in a centralized fiscal instrument? Some scholars pointing out, I guess you read that kind of articles also, about, well, a potential European central debt agency. I don't know if you have, well, studied that kind of possibility, or what about these new facilities that you mentioned?
Yeah. So these are two very different topics. Several academics have proposed that the ESM takes over a lot of debt from its member states, so that we would become, either to some extent, large extent, or completely become the debt agency for euro area countries. So that then the Spanish debt office and the German debt office, they would close down and we would do it on their behalf. These are academic proposals.
And how do you see it?
I see no appetite in our member states to do that. Would be a big step. Maybe it happens at a later stage when we have completed some of the other important steps that would lead to deeper integration. I mentioned banking union, capital markets union, maybe one day, but I don't think it will happen before my retirement, so it will be a while. So that's on the debt agency. There are also some other academic ideas that we should take over some of the bonds that the European Central Bank bought during these last few crisis years, and then manage that on behalf of our member states. But again, no appetite in our member states to do that. But it's always good to get new ideas, and that's why we have a vibrant academic community. It's their job to come up with something new, which may not be implementable for quite a while, but it can create some new ideas and maybe one day can become then very useful.
But the thing is, the academia is trying to figure out how the future of the ESM could be. How do you see the future of the ESM?
But first to your other question, and that's linked, you asked about a specific facility for macroeconomic stabilization. This is something that some critics of the monetary union have been suggesting since the beginning, since monetary union started. And we don't have a specific facility to cushion macroeconomic problems. We do have now with the ESM, what we did 10 years ago, a facility when there's a big adjustment problem, like we had in Greece, where really tough adjustment had to be done, like cutting pensions and civil service pay and drastically reducing the fiscal deficit, but importantly also taking measures to regain competitiveness. That's one thing. What we don't have is for smaller crises when a country enters into a recession, and there it could be useful to give European help to add European fiscal space to national fiscal space. Countries should always have also national fiscal space to react to a crisis. But after all the debt increase during the last two crises in all countries, it could be useful to add something here, and the ESM would be equipped to do that. So far, no consensus, but it's another idea that's on the table and may lead to something eventually, but not this year.
And the future? How do you see the future?
The future. Well, the ESM has its toolbox. At the moment, we are managing the outstanding claims, because one characteristic of our loans is that they can have a very long maturity. Greece, which was the biggest problem 10 years ago, has some loans from us that run for 40 years. And they very happily benefit every year from the low interest rates. Some people are wondering how Greece can survive at the moment with a debt to GDP ratio of almost 200% of GDP. It will actually drop this year below 190%, but still by far the highest in Europe. How can they manage? And the answer is very simple, because more than half of that they owe to my institutions, where they pay very, very low interest rates. And it's very stable because it's a long-term loan. They don't have to be afraid that when there's a small hiccup in the world economy, capital would be withdrawn, investors would run away. And the good thing is that other private sector investors, they know that. They know that our money will be there, it's stable, it's cheap. So they, therefore, with more confidence, also are willing to invest in Greece. So that's the lasting benefit of what the ESM did during the euro crisis. And in our day-to-day business, we have to refinance the outstanding loans. So that keeps a large part of my institution busy, because we issue bonds, as I mentioned, to finance our loans. We don't use taxpayers' money, no tax revenue. But there's a mismatch in the maturity of our bonds and the maturity of the loans. So although we have no new disbursements now for the last few years, we still need to issue bonds to refinance existing claims. And that keeps us busy. And then we will get a new mandate. We are in the process of ratifying a change of the ESM treaty that needs to be ratified in all parliaments of our member states, where we would create a new facility, a backstop for the Single Resolution Fund. That is one of the institutions that was created as part of the banking union in response to the euro crisis. And this resolution fund exists to unwind banks if necessary. That normally costs money. The Single Resolution Fund has its own money from contributions from the banking sector. But if there's a big crisis, they may need more money. In the US, the FDIC operates in the same way. They have money from the banks. But if they have a big crisis, banking crisis in the US, they can draw on a credit line with the US Treasury. In Europe, in the euro area, we don't have a treasury, but we have the ESM. So that's why we were asked to provide this backstop, which we will do when our treaty is ratified later this year. And this could be up to 68 billion euro. And it also means that we don't just need to have the money ready or be able to provide financial assistance on short notice. We also need to understand what's happening in the banking sector in Europe. So therefore we work then closely together with the European Central Banks, the Single Supervisory Mechanism, the Single Resolution Board. So this is a new mandate that comes on top of what we have been doing so far.
Okay, thank you. I would like to ask the same question to the both of you from your very different perspectives, but let's start this time with Mr. Garcia. It's about the fiscal rules that they are being discussed right now, how they can play a role in coping with this shock energy, and what the Stability Pact could do to try to offset the energy shock and the prices effect. So, what do you think?
Yes, I think first on, I think on the fiscal debate on the euro area and in Europe, and reacting to what Klaus was saying, I think there have been quite significant innovations in the last few years. You know, nobody kind of expected the European Commission to become a large issuer of debt, just as one of the big debt agencies in the euro area, like Germany, Italy, or Spain, and that is what is happening with Next Generation EU. I think that's a major step forward. And also, we don't have a stabilization mechanism, but we've had the SURE mechanism, which is interesting, and it might be interesting as an example for that future mechanism of macroeconomic stabilization in the euro area. As to the debate on fiscal rules, I think we spelled out our position, I think now more clearly in the paper that we published with Vice President, published with the Dutch Finance Minister. I think what we're seeking is a reform of the rules which makes it consistent, the reduction in debt and in deficits with growth. You know, we think that there is an overarching goal is to make this recovery sustainable and strong and durable. So that is very important. The rules must be flexible because after the COVID situation, the fiscal situation, the fiscal space in euro area and European Union countries very different. So we can have some flexibility as to the paths of debt reduction for the members. Rules must be simpler, and that is something I think it's a widely kind of shared concerns and objective. And fourth, the reform of fiscal rules needs to take into account investment needs. They need to facilitate investment processes that are stable and that are medium intense, so as to be able to cope with the investment needs that we have from the energy transition and the digital transition. And now, of course, we will have more challenges. I think these lines, are quite sensible, are in line also with some of the more mainstream kind of proposals that are on the discussion. For us, it's also important that this is a very kind of pragmatic discussion, and we kind of try to kind of be united, to come together with a common vision, and do not fall back to the old kind of divisions that have not been productive and will not be productive for the challenges that we now have ahead of us.
Okay, Mr. Regling, any take about fiscal rules?
Oh yes, I've been working on that for 30 years, so I have some views.
Specific to this moment of the inflation shock.
No, it's one of the big issues on the table for this year, because it's very clear the monetary union needs fiscal rules to coordinate well, because the large majority of our fiscal action happens at the national level. We have an EU budget, but that's relatively small. We have now facilities with ESM, EIB, Next Generation EU, but still, most of the fiscal action is at the national level. That's the characteristic of our monetary union, where monetary policy, exchange rate policy is totally centralized, and fiscal policy mainly remains decentralized. And some critics already in the 90s said this will never work. And the answer was always it can work if the fiscal side is well coordinated. So that's what the Stability and Growth Pact does. But there is, as Gonzalo said, wide agreement that we need a reform, because the existing pact has become too complex. It works with non-observable variables, and there's no agreement how to measure them. There are too many exemptions. That's not very credible also in financial markets. And it's also difficult if policymakers, parliamentarians, and the public doesn't understand how they really work, these rules. So there are many reasons to reform them. But it will not be easy to do that, because there are many objectives that people connect with the Stability Pact. And Gonzalo mentioned a number of them. In the Dutch-Spanish paper, which I welcome very much, because it was very good to see that two countries that on these fiscal issues often were arguing against each other, that they are able to work together and have a common proposal. It's also said very clearly that the key objective of the fiscal rules is to maintain debt sustainability. And that also the way I see it. We have many objectives, but in my view there's a hierarchy. Debt sustainability for me is the key objective. And then, of course, the other objectives are also laudable. They are important, like promoting investment, also be counter-cyclical, support the transformation to green. So many objectives, but there should be a certain hierarchy. And to put that all together will not be easy. It will be one of the controversial topics, but it's important to work on it. And we will do that the remainder of the year.
Okay, thank you. We are on top of the hour. I'm going to ask the organizers if there is any question from some media that are following us. Okay, I can keep asking questions, but 5 more minutes. Okay. I will go with Mr. Garcia again. Then, I'm coming back to a previous question, so sorry for being so persistent, or like the inflation. So this is the question: how persistent can be this inflation in Spain? Because Spain has a chronic disease about high prices. We are
used to have.
Right now that we are doubling. Spain is doubling the level of prices with Portugal, for example. It's about
No.
Portugal
doubling.
is around 5.6.
It's not doubling, and not the level of prices, but
I'm talking about inflation in March.
yes, but no, it's not doubling, and we used to have a problem. No, okay, sorry, go on.
My question is why is always the gap like huge? I mean, it's the widest gap in the European Union, no? From the average, Spain used to have the wider gap. And for example, with Portugal, which is our neighbor country, and we share this common problem about how to form the electricity in the pool, and we are having this common Iberian exception to try to fight the same problem. Well, Portugal has a much lower inflation than the Spain has. So just wondering what can be the secret.
I think that the difference lies with how the electricity consumers are accounted for in the CPI, which in our case, as you know, is the regulated tariff that it comes directly from the wholesale price. And in countries like Portugal, it's not the same. But I think, as Raymond said at the outset, there are 7 countries with double-digit inflation in the euro area. So we are having a burst of inflation. In our case, we are above some countries, below some others. There's this element of electricity. 70% of inflation is explained by electricity prices and food. And so and I think in the last 10 to 15 years, we managed to kind of address the problem that we used to have. Now I think the question is to ensure that we can keep that price stability and that we can come back as soon as possible to inflation, which is close to 2%. The IMF forecast last week, I think it was 1.3% for next year. And similar figure for next year. The Bank of Spain forecast for next year is around 2%. So.
And the government?
We don't do CPI.
I know, but you have to make something.
we don't do CPI forecast. We will kind of do all in our macro framework. We will have the deflators as we usually do, and other countries do. And of course, this year inflation will be abnormally high, and the goal is, as the forecasts are saying, but also because of the measures that we've adopted, that the peak in inflation is behind in the first half of 2022, and then and the kind of downside path of inflation is as fast as possible, and that the measures we're taking is to try to favor that first. Addressing the cost, which is energy prices, and then trying to kind of broker to push for that pacto de rentas, for that income agreement that will help reduce the risk of having persistent effects.
Yeah, I was going precisely to ask you about that, because unions are asking employers to reach an agreement to try to compensate in this year, in 2022, all the inflation, but trying to recover part of the purchasing power in the coming years. Apparently, there is no an agreement on the table. I don't know how the government can persuade both actors to try to get this pacto de rentas goal, and how much the economy can resist this kind of prices, and if you are so sure that there are not going to be any kind of second round effect, because core inflation is also on a rise.
Well, I think the central banks and the Bank of Spain, they are ruling out second round effects, and that I think it's reassuring. And the fact that we're taking measures to have inflation kind of go down faster, I think will help to reach that goal. But I think the agreement, I think the president said it's just when he first presented the plan. I think this Pacto de Rentas, and we have some experience decades ago, I think it's a very kind of useful tool. to give certainty, which is what we need, and everyone kind of compromises a little bit, looks forward, and that will help us to reach the goal of having going back to 2% inflation as soon as possible.
Okay, thank you so much. I can keep making questions, but we are out of time. So thank you so much again to FUNCAS for hosting this event. I will pass sorry, to you the take. Mr. Torres, thank you.
Thank you, Belén. First of all, thank you very much to all three of you, Carlos Reglin, Gonzalo Garcia, and yourself as moderator, Belén. I think this was a very interesting discussion. I think I have the impression that you coincided, broadly speaking, in terms of the two main issues you cover, which is inflation dynamics and also the role of fiscal policy, which is very interesting. In terms of inflation dynamics, you both emphasize the importance of addressing it quickly because the negative effects are very important, and you even mentioned, Mr. Reglin, the possibility of a possible stagnation which may not show up in aggregate figures. So in other words, because of the carryover effect, so it is quite significant. And but I think you, Gonzalo Garcia mentioned the issue of the second round effects. So on the positive side, one can say that for the time being, unlike the United States, I have the impression that the second round effects are still not so significant that would prevent any anti-inflation policy to work. And so I think there's also this reassuring word. And on fiscal policy, I detected also some convergence in terms of, for example, avoiding general measures like general tax reductions, for example, as you mentioned, or free riding between countries in terms of tax policy. But at the same time, you both emphasize the importance of having fiscal rules, common fiscal rules. Why I did not see very clear message there would be for another meeting would be the common fiscal capacity. What kind of common fiscal capacity? Perhaps the Secretary of State mentioned the Shura, the experience of Shura, based in a common fiscal capacity on the successful experience of the Shura system as a first step, but maybe that would have guaranteed another debate, which we don't have the time today. In any case, thank you both of you, as well as Belén for moderating the event. It was great having you here in FUNCAS. And with this in mind, we are going to close the meeting. I know Mr. Reglin has an important meeting immediately, and not to mention the Secretary of State with the many issues that will have to be covered even already this week. Thank you very much to all of you for attending this event.